Hi, everyone. Welcome to Pitch Perfect. I am Shashi Srikantan. I'm a managing director here at the Hearst Corporation, and I'm the head of Level Up Ventures. We are an early stage, sector agnostic investor focused on backing exceptional Black and Latino-led startups. As part of Hearst, we're one of 5 internal corporate venture capital arms. And our mission at Level Up Ventures is to invest in founders who are redefining industries and innovating within the gaps left behind by traditional venture capital. At Level Up Ventures, we're not just about the capital, although that's very important. We really bring the full strength of Hearst's ecosystem. We've got over 370 businesses spanning media, which many of you know about, but also spanning across healthcare, transportation, financial services, sports and entertainment, and other sectors which you may not be aware of. This means strategic support, access to deep industry expertise, operational resources that can truly move the needle for startups. A critical pillar of the support that we offer is our Scout Network. This is a network that's made up of passionate Hearst employees and colleagues who lend their time, expertise, and connections to help the companies that we invest in, our portfolio companies, thrive. Our scouts help us with everything from sourcing and evaluating startups, but also making valuable introductions, providing hands-on support, mentoring, et cetera. It's a really vibrant ecosystem of kind of cross-functional support that's driven by individuals who really share our commitment to empowering diverse founders. We're also really fortunate to have incredible resources on our team. We've got our Level Up team, and we've got Ike Iwator, our senior venture analyst, here on the call. But we've also got incredible external resources. We've got advisors, mentors, and venture partners, 2 of whom will be co-leading today's webinar. And we're just really proud of what we've built, the impact that we're making. We're always looking for kind of bold, creative founders who are solving meaningful problems. And by partnering with us, you're not just gaining an investor, you're getting a network and a team that's really deeply committed and invested in your success. So that's my pitch for Level Up Ventures. But I appreciate you all joining today. I hope you find this session engaging and really insightful. And with that, I'm going to go ahead and pass it off to our venture partners, Gary Stewart and Kange Kaneene, to introduce themselves.
Great. Thank you, Shashi. And one of the things that I really love about Level Up is they make it very easy to expose yourself as a founder. So if you do think that you are qualified to apply, we will send the link after this so you can submit your investor deck and hopefully be evaluated by the team. My name is Kange Kaneene. I'm one of the venture partners, as Shashi said. I formerly was at SAP running the Startup Accelerator for the Americas, which is North and Latin America. I'm also an angel investor and been in enterprise software for the last 16 years. Really happy to be here today.
Awesome. And I'm Gary Stewart. So Kange and I will be kind of leading the session. My background is, in addition to being a venture partner at Hearst, I also have a startup called mycofounder.ai, which we like to say is like Perplexity meets LinkedIn for founders. What does that mean? It's an answer engine and a recommendation engine to help underrepresented founders get funded. So if you are one of those founders, please also feel free to reach out to me. Here's my email below. And before that, I was an MD at Techstars New York City, powered by JP Morgan. And sometimes I'm also an inaugural lecturer of entrepreneurship at Yale Law School. And so without further ado, we're going to go through a little bit of the agenda for today. You've already met us, so the next thing we're going to talk about is think like an investor. We're going to talk a little bit about venture math. What does it mean to be a venture-backable startup, and how do corporate venture capital funds fit into all of this? Next, we'll talk about something called the Valley of Death. It sounds less ominous than it really is, or more ominous than it really is. And then kind of how traction and product market fit fits into all of that. We'll look a little bit about kind of knowing your stage and risk profile, and what we're trying to say here is a lot of times founders will say, hey, I want to meet Sequoia tomorrow, and people will look at you a bit askance, and we'll explain to you why that might be the case. Why sometimes you might be rejected for asking for too little funding, even though that seems somewhat counterintuitive. Why investors really focus a lot on their investor thesis, and why you should know that before you approach an investor. A little bit about the venture funnel, how it goes from sending in a deck all the way to getting funded. How to secure your first kind of meeting, elements of a pitch, common pitfalls to avoid, and then lastly, we'll open it up for questions and answers. If you guys have any questions during the meantime, you don't have to wait until all the way at the end. Feel free to send them into the chat and then we'll be monitoring them, and then we'll be ready for them at the end of the presentation. So without more ado, let's get into it. So the first concept we really want to talk about is founders should think like an investor. And what does that mean? It means that a lot of times when you're listening to a founder pitch and you're the investor on the other side, you're like, that was really great for 3 minutes, but I have no clue why there's an investment case here being made. Because a lot of times founders will spend a lot of times talking about their product or a lot about themselves sometimes. And all that's really great, but none of that actually helps the investor to figure out whether or not this is actually a good investment. And that's for two reasons, particularly when you're talking about venture capitalists. One is that venture capitalists aren't usually investing their own money. They're investing someone else's money. And we're going to explain a little bit about why that then shapes the way that they have to approach talking to founders. And secondly, their jobs depend on generating outsized returns. So they're not looking for good companies. They're not looking for profitable companies. They're looking for quote unquote unicorns, companies that are so rare that they're able to IPO and then generate massive returns or be acquired for a lot of money and generate massive returns for the investors while at the same time mitigating very kind of clear risks that a lot of companies have. And please note that this logic may differ somewhat when we're talking about angels who generally are investing their own money, accelerators that have an approach that we call spray and pray. So they're looking to invest in lots of companies as a way of hedging risk, and then some CVCs. So going to the logic of like venture backable startups and kind of what venture math really means, first we have to understand how venture capital funds are generally structured. The way they're structured is you have two different groups of people. One group will be called the limited partners or the LPs, and they're the people that it's their money, right? So like let's say, for example, I am Jay-Z, or I am Yale, or I am some New York State's pension fund. It's my money that the venture capitalist is really investing. It's not their money. So when they say they have $1 billion assets under management, that's $1 billion of my money that I've given to them. Not me, really, but you know what I mean? $1 billion that they are being given to invest for someone else. And the idea is this person needs to see an outsized return. Now, what does outsized mean? It means more money than I could make if I just put that money in Nvidia stock, more money than if I had just left that money in an index fund, more money than if I had left that money in real estate, or anything else that's more traditional and less risky. So if I'm going to do something that might be considered to be risk capital, the risk and reward ratio have to be aligned, meaning that if I'm taking a huge risk on these early stage companies, I need to see a massive return, right? But investors know that in general, because it is such a risky endeavor, the vast majority of companies that they invest in, even at like Series A, are never going to give them a massive return. So each and every company that they look at has to be a potential fund returner. That means that one company has to be able to return the entire fund. So what does that mean mathematically? If I have a $100 million fund and I need to return $300 million, and I'm aiming to have 25% of the company, as we're going to talk about later, that means I need the company to be able to exit for $1.2 billion so I can give each company that I see has to have that potential if they're going to be a fund returner. So that's a little bit about the math that venture capitalists have to kind of take into account. And you also have to take in one last number, which is that 95% of VCs will fail to ever generate that return. So it's only a small subset of VCs out there that ever really generate those sorts of returns, which is why a lot of times you'll see people saying, okay, I'm not a lead investor, because they're hoping that the lead investor is going to be someone with that track record of generating outsized returns, right? So we can look at the bullet points below, but the idea is the same. Investors are not looking for you to just return their money. They're looking for you to return their money with a 10 to a 100x return so you can be a fund returner. That's why they ask you to look at the market size, because if your company is going to be able to generate a valuation of at least $1 billion, then that means that the market has to be large enough to be able to sustain it. They're going to look to see that the market is growing. So this is why they invest generally to follow trends. So one moment they're focusing on VR, AR, the next moment they're focusing on Web3, the next moment they're focusing on AI, because they're always trying to focus on a market that they think is growing quickly. And they're trying to figure out who's going to be the person or the team that's going to be able to capture a lot of the value being created by that market growth. They need to see the companies growing really quickly, because the only way you get from a company that's generating, let's say, $2 million in revenue annually to a company that's generating 100 million in revenue annually is if the company is growing by 2 to 3 times per year, right? So that's why they're looking for companies that are growing really, really quickly. Why you'll sometimes hear they're looking for high growth startups, because high growth startups are able to get to $1 billion valuation within a relatively short period of time, which is the life cycle that the VC has, which is usually 5 to 10 years when we're talking about seed stage. They're looking for companies that are going to be capitally efficient. So that's why you'll see people say, okay, I don't invest in like hardware or consumer or biotech because those are not capital efficient. They want to know that the money is growing, going to scale growth and not going to sustain operations. And lastly, they have to have some sense that there's a way to get their money back at the end of 5 to 10 years. So they're not your partners for life, they're your partners for 5 to 10 years. And so they need to have what they call like an exit option, which for them preferably is going to be an IPO, so kind of a public offering on the stock market, NASDAQ, New York Stock Exchange, et cetera, or some large company is going to buy you for a lot of money, Google, et cetera. So the moment that you take venture capital funding, just know that your investor is thinking of this as a short-term fling, likely to last about 5 to 10 years. They're not trying to be in your company for the next 10 to 100 years, and for the most part. So let me go to the next slide. So this is kind of where we talk a little bit about corporate venture capital and how it's slightly different from the traditional venture capital game, right? So usually when you have corporate venture capital, it's a large corporation like Hearst that has decided that it wants to fund startups in exchange for getting equity. And there's only one LP for the entire fund, right? So the LP in this case would be Hearst. So they don't have to worry about some of the other considerations that traditional funds might have. So the first thing that we can focus on is that CVCs, they can look not just at the financial return, but they might also have like a strategic aim that they're trying to realize, right? Whereas traditional VCs only focus on financial gains. Secondly, they bring certain assets to the table that a traditional fund might not bring to the table. So one of these might be industry expertise. Maybe they know a lot about the industries that they're working in. So again, you can look at Hearst, or let's say, for example, you got Google's AI fund to invest in you. It'll be really wonderful. Or now I know, like, NVIDIA and OpenAI and Anthropic might be opening up their own venture capital funds. And if you have a company that's in the generative AI space, it would be really great to kind of be able to tap into their expertise, into their know-how, as well as their network, right? They're going to know all the right people in that space that can be really useful to you, that maybe they wouldn't want to speak to you because you're a small startup, but because they already have these existing relationships with the parent company, they might be willing to be introduced to you, which can kind of be a tremendous benefit that some traditional venture capital funds that are not corporate backed may not be able to do on their own. There's also the notion that they can give you credibility. So particularly if you're a B2B startup and it's really hard to get that first customer that's a corporate, et cetera, if you can say that you're working with a large corporation already that not only is working with you or partnering with you, but it also has invested in you, that's a huge amount of credibility that other people are going to use as a positive signal that there's something there. It's not kind of a crazy idea. CVCs also might have a longer time horizon because they're not looking to pay someone else back in 5 to 10 years. They don't necessarily need to kind of think in those 5 to 10 year time cycles. And the only kind of negative, I guess, for CVC is that sometimes they may have a lower risk tolerance because most of them, the core business is not going to be investing in startups. So they need to kind of balance that with the reputational risks of certain startups. So they may not do stuff like cannabis or companies that they think may be somehow a reputational risk to their business. Because at the end of the day, again, it's not a core business. So with that kind of explanation or caveat inside, now we can kind of look at what's called the valley of death and why it is important to focus on traction and product market fit and what these really mean. And so what we're really talking about with the valley of death is, when people say 90% of all startups die, this is what they're talking about. Majority of startups, even if they get a little bit of funding from their family and friends, as we can see in this bracket here, the real trick is, are they going to be able to build a product? Are they going to be able to get customers for that product? And are they going to be able to get customers to pay for that product? So those are the three major challenges that founders have within, I would say, the valley of death stage. And the vast majority of companies die because they can't answer those three questions, right? So because of that, a lot of traditional venture capitalists will just stay away and they'll say, well, until you kind of have the traction to show that you can answer those three questions, you built a product, you have customers that are using it regularly, so you have people that are using it regularly and are willing to pay for it, and we can do the math and figure out whether or not they're willing to pay something that will make the business eventually sustainable. Investors may not be willing to invest. And this is kind of the concept of product market fit. When there are enough people using your product to show that there is a market for your product. Some people traditionally have used the kind of metric to define that as about 100,000 a month recurring revenue for, let's call it, Series A investors. But then others that might come in a little bit earlier, like let's say seed stage investors, might use a smaller number like 15, 25,000 a month recurring revenue. But the idea is that they're looking for recurring revenue because they want to know that there's a business model that works, and they want to see that people are paying for it, in general. Back 2 or 3 years ago, that might have been less the case because there was such a huge appetite for anything that people were willing to kind of overlook some of the math. But I think we've reverted now back to kind of people wanting to see actual traction before they kind of really put their money because they just see pure risk. So this is usually going to happen sometime between launching the product and achieving product market fit or consistent revenue. People are going to be looking to see what your burn rate is. So if you don't have any revenue or not enough revenue, but you're burning like $100,000 a month, that's probably not a really good sign. If your business model, we see this a lot as well, where there's revenue, but it's not recurring. People are going to kind of look at that as kind of a negative as well. And it might be difficult in those contexts to raise additional funding. Yeah, so we already talked about the last two bits, which is that most VCs don't really want to invest pre-product market fit, which is this point right here, because it's just too much risk. And again, they're not investing their money in someone else's money, and they don't want to lose that person's money because if they do, it means they won't be able to raise a second fund, and so they've kind of failed too. So during this stage, what you should really be looking at are angels, accelerators, non-dilutive funding, grants, et cetera. And you should be looking to kind of keep your burn rate as low as possible because you need to kind of basically prove that there's something there, which you probably haven't at that point if you don't really have the metrics. So to kind of put this into kind of some sort of like relief, let's see what exactly we mean, right? So we already talked about this, that the goal of a startup is to get to a recurring scalable business model, right? Recurring means that's why people focus on things like monthly recurring revenue. They want to see that there's a stability there and scalability. They want to see that it's growing quickly so that you can be one of these companies that are generating 2 to 3x growth on a year-to-year basis. Some people say they're looking to see 20% month-on-month growth, et cetera. So let's look at kind of, and this is based on Carta's most recent analysis of the companies that are the clients or their customers, what it means to be pre-seed, right? And some of these terms change over time, but at least as of Q3 2024, this is what we're talking about. Pre-seed means that you have an idea, there might be some initial validation, but not much, and you might have an MVP, but it's not much more than that. So the main risks that investors are going to be looking here are, is there a good team and how viable is this concept? Usually the only people that are going to invest at this stage are people who really like you. So the founders themselves, your friends, your family, angel investors that have a higher risk appetite but might be able to write smaller checks, and accelerators that do more of this transferring model. And the funding range, at least based on what Carter's analysis says, is that usually the pre-seed round is somewhere between $50,000 and $1.5 million. Seed stage, again, the expectation is that you're beginning to approach product market fit. It's not fully there yet. It's not at the 100,000, or maybe nowadays it might be $300,000 monthly recurring revenue. But there's some initial traction. Maybe it's 10,000, 15, 25,000, so that they can see, okay, someone's willing to pay for it and this product actually works, and their people are actually using it. So it's in between the kind of pre-seed and Series A. So the risks there are you actually going to be able to acquire enough companies, and this is still a scalable business? And at that point, you're looking still at angel investors, still at accelerators, but there may be certain early stage VCs that are willing to play that early in the game. And here the funding range is about $2 to $6 million. And then the last bit that we'll look at, and then there's kind of growth stage VC after this, but probably it's not relevant to most of the folks on the call. Please correct me if I'm wrong, is that at this point you do have a proven business model, right? So if the goal of early stage startups is that you have a recurring scalable business model, by Series A you have proven some recurrence and some scalability. And at this point, we're talking about 100,000 to 300,000 monthly recurring revenue. Now, the reason that the range has expanded is that over the last few years, as venture capital has become harder to come by for founders, the amount of money that some investors are looking for has gone up to about 300,000. And really here is where they kind of think that you've escaped the valley of death, and they want to put the money in to give you gasoline. Like, they don't want to give you the money to build a car, but they are willing to give you the money to have the gasoline to go really, really fast. And so the focus here is on scaling, competition, and again, this is where traditional VCs come in, usually with a funding range of $6 to $20 million. So, what is one risk factor that we would see here? If you are pre-seed, you don't have the product built, you don't really have any users, but you say you're raising $10 million, it may not jive with a lot of investors because they're going to say this person may or may not fully understand the way the game is played. I have a lot of better options for $10 million where they already have 300,000 in monthly recurring revenue, et cetera, et cetera. Why would I put that money in, from an investor's point of view, in a company that doesn't have any of these things? So I think it's important to just know what your stage is and the amount of risk that's attendant to investing in that particular stage. So then now we're going to look really quickly at kind of, so why, if all of that is true, would someone say that I'm not raising enough money and so therefore they can't invest in me? Because this actually does happen. One is going back to the investor map. Remember that investors generally have certain assumptions that they presented to their limited partners about how they're going to make them a lot of money, how they're going to generate that 3x return on the total size of the fund. One is they're going to have a thesis as to how much they need to invest per deal to be able to get get the returns that they predicted. Uh, Two, they're going to have certain assumptions about like what ownership stake they want to have in each company by the time the company is about to exit. And so here you see that it's traditionally about 15 to 20%. They're also going to want the companies to have enough money to be able to survive 18 to 24 months so that like you can spend some of the time not raising money and actually running the business. And it's actually that's the whole point. The money is the gasoline, but you still need to drive, you still need to kind of go somewhere. And so they want you to kind of have enough money so that you can kind of forget about fundraising for a little bit. So that 18 to 24-month kind of runway is important. Again, we kind of talked about this before. Most VCs are not spray and pray. That means that they are only investing like in 5, 10, 20 companies for the most part per year or throughout the life of the entire fund. And so they're not looking to have lots of companies to invest in. They'd rather have fewer, but really high potential companies that are kind of doing slightly better in terms of like hitting their metrics. And lastly, they may be looking at what your competitors are doing. So if your competitors have raised like $5 million and you're raising $500,000, maybe they're saying, okay, well, this I don't see how you're going to win, given that you have an incumbent or at least a competitor that's already better funded and they have good investors, and we're not sure what your strategy is to win. All right. And so I think now we're going to talk a little bit about the thesis, right? Because I think this is another mistake that a lot of founders make. You know, and I made it myself the other day, so it's not even just other founders, it's me too, where sometimes you'll send a deck out to an investor and the investor comes back and says, hey, I really love what you're doing, but I only invest in healthcare, right? And you're like, oh, sorry about that. So I think as a founder, you really have to understand again that because VCs are not investing their own money, they're investing someone else's money. Part of their pitch to those investors is we think that the key to getting that 3x return on the fund is to invest in seed stage and Series A healthcare companies that are focusing on payer systems, right? And so they're kind of like almost legally limited to what they're supposed to invest that other person's money in. There may be certain caveats or like discretion, but just generally think that when they say that they have a thesis, that thesis is there for a reason. It's not that they're just making it up as they go along. So if an investor says that they're not a generalist and they have clear things that they prefer to invest in, kind of take that seriously and tailor your pitch to make sure that you look like what they are searching for. Because again, since they're not investing their money, they might not have that much discretion to just deviate, even if they really like you. And you're probably wasting your time if you're sending out a lot of pitch decks to people who can't invest in you because you don't fit the investment thesis that they've agreed with their limited partners. So here, these are some of the reasons that you would do it. But in general, the idea is that you'll seem like you'll probably convert better if your pitch actually aligns and is tailored to what the investor is actually looking for. You'll seem more credible and you'll waste less of your time. And then I guess the last thing we're going to talk about, I think before I turn it over to Kange, is, how does the process actually work? And why is it that, a lot of founders end up being really, really disappointed? I think, again, just understanding kind of the mathematics of kind of the process and the pressures that investors are under, they have to look at a lot of deals. So like, let's say Andreessen Horowitz said that they look at about 3,000 inbound applications, but they're only going to seriously look at like 200 of them. So what they're doing early on, and this is probably going to be someone junior on their team, is doing it. So it's not going to be a partner or like even a principal. Usually, is someone junior have to kind of just go through 3,000 applications over time and get down to 200 that really they want to take a serious look at, right? They're probably not going to spend more than 2 to 3 to 4 minutes. Actually, the time that DocSend says the average investor spends reading a deck is 3 minutes and 45 seconds. So think about it. You're going to have less than 4 minutes to convince an investor to go from just being an inbound application to one they're going to look at seriously. And then of the 200, the likelihood is that they're only going to end up funding about 20, right? So the odds are against you, which is the reason that you need to make sure that your materials are not just good, but completely on point. You're trying to win the gold medal. You got to bring your A game, right? And so the funnel is going to be from that initial contact, which can come either through a cold outreach or a warm intro. And usually people prefer warm intros, but we can see like that's what my startup is about, seeing if we can kind of turn cold outreach into warm intro. So again, reach out to me, shameless plug. But that's going to be the first bit. You reach out to them. You're going to get screened by the analyst who's going to take it from 3,000 to 200. So that would say 2,800 of the 3,000 are going to get rejected at that stage. Then if there is enough interest, then you'll have the first meeting that might be with an associate who's going to ask you some questions. If they like you enough, then you go to the next stage, which might be due diligence with someone that's more senior, so the principal or the senior associate. And that's when they're going to really try and dig into the business to understand the business model, the market, the financials. If all of that goes well, you probably will then get a meeting with a partner who is going to present, and it might be a presentation to one partner or to various partners. And they're going to that's going to be the really hard meeting. And that's a really, really difficult meeting to get because you're already kind of almost towards the end of the process after they've weeded out, like probably at that point, 2,900 startups of the 3,000 that have applied. And then if you get to that last phase, then you'll get before an investment committee, which is probably an independent group of people who have been put there to make sure that the limited parts, the general partners, who are the investors that you usually see, have made a good decision, right? And so they're there to kind of sense check to make sure that like companies that shouldn't get through the process don't go through it. So it is really difficult, which is again why you need to make sure that all of your stuff looks really good and on point so that you have even a chance of being taken seriously. And with that, I'll now turn it over to Kange.
Great, thank you, Gary. And just a reminder, if you do have any questions, I know this is a lot of really helpful material, please put it in the chat or the Q&A box and we will answer those questions live after the presentation. So Gary just talked about what investors are motivated by so that you can tailor your pitch to make sure that you're answering the questions that they want to hear. However, of course, that doesn't matter unless you understand how to actually get the opportunity to pitch to an investor. So I'm going to spend some time talking about how to secure the pitch. The first one is get really comfortable talking about your pitch all the time. At the lounge at the airport, your Uber driver, the cocktail party, everywhere. You never know who's connected to who, and you'll be surprised how much just speaking about where you want to go will help you scale your startup. Second is make a list of targeted investors based on thesis. Gary just talked about how all investors have a type of startup they need to invest in. And there are a lot of tools that do that. You can see them on the slide here, where you can try to filter investors based on what your startup is doing. Once you have that short list, then leverage networking tools such as LinkedIn to see, do you have any overlap between those investors and your network so that you can ask for a warm intro. Unfortunately, venture capital is still a very much networked business. It is possible to reach out to investors who you don't know and get funding, but that's very rare. In general, most meetings come about from warm introductions. And so if you can facilitate that, you have a higher likelihood of getting that meeting. So if someone in your network agrees to do a warm introduction, please make that as easy as possible for the person making the introduction. One of the ways to do that is to have what's called a forwardable email, meaning you write an email on behalf of the person making the introduction so that all they have to do is forward that email. Here's some ways to make that email really productive. One is make it a clean email, meaning don't bury the blurb in a chain of emails, make it clean so that literally someone can forward it. Don't use third person. So instead of saying I or we, again, you're writing this email on behalf of someone else. Highlight 3 or so points specifically about why your startup is interesting to the investor, given what the investor is looking for. And finally, include some materials so investors, the email recipient, can learn more using a digital link. So that could be your pitch deck or a one-pager. The reason why I'm saying digital versus an attachment is because one, you're going to constantly update your pitch deck. And so if you can make sure that every time someone clicks the link, it's the most up-to-date, that's to your benefit. Second, a lot of times you can actually monitor who's viewing the pitch deck, which is good for you to know as a founder. And third, as someone making the introduction, if I'm going to introduce you to many different investors, having that link versus having to store the attachment is just more effective. Of course, if you cannot make a warm introduction, then the next best thing is to reach out directly. So that's doing things you would assume, like find someone on LinkedIn. Some VCs, like I mentioned, Level Up is one of them. They actually allow you to pitch on their website, which is really helpful. Then finally, in your local community, if you have events that take place, you'd be surprised. A lot of investors who you've been having a hard time finding might be speakers at those events. And that's a really good way to try to approach them in person to pitch your startup. Next slide, please. Other direction, please. Thank you. So this is just a quick example of what a good forwardable email might look like. Very straightforward. The top is just saying, I think you should look at this founder. Here's a very quick explanation of what they're doing. In this case, I'm saying Uber for fashion with a link. And then this is what I was talking about, 3 things that you want to call out about your startup. Again, these 3 things will be different depending on what you're doing. In this case, I'm talking about team, traction, and existing investors. On the right-hand side are just some examples of times where I've been asked to give a warm introduction and was underwhelmed by the information provided to me. So first was a cut and paste of about us on the startup's website, because typically that is for your customer and not necessarily appropriate wording for an investor. I've also been given just a link to the demo and no other copy, or the bio of the founder. Again, all those things, you're making me have to do the work to kind of add more information, which might not actually be accurate. So if you can try to just make it affordable, then better chance of success. Next slide, please. Okay, so now what you've been waiting for, which is what actually goes into the pitch. So first, you need to make sure to define your company in just one sentence. And it's more, I think it's easier to consume that sentence if you can try to compare it to something that the critical mass of people already know about. So here are 3 examples of taglines I've seen that were intuitive to me. TurboTax for child support collection, SoulCycle for acupuncture, line of credit to help individuals get their employer 401k. So you get the idea, something that you know compared to what you're doing, so people can get a high level understanding of what you're working on. When you are an earlier stage company, typically investors are leaning more on feeling out how much they like the team than the actual solution, because it's maybe too early to have actual traction that can model in a positive way. So storytelling is really important. That's an opportunity for you to maybe be vulnerable and try to establish a rapport with an investor so that they can feel like they can trust you as a founder. So there are 2 ways I've seen people effectively tell a story in the context of explaining their startup. One is lived pain. An example of that is I met a founder who's had a loved one who was battling cancer. All the treatments weren't working, had to then look at clinical trials and had a hard time understanding how to find clinical trials and how to identify if a patient would be eligible for a specific clinical trial. And so her startup is about making more transparency there. I thought that story was effective to understand like why someone would want this solution and also why she's particularly passionate about solving the problem. The second is lived the solution. Another example of a founder who has led a lot of large teams of salespeople and gave the same feedback over and over to his direct reports that are salespeople, and decided to create a solution that monitors Zoom meetings to give real-time feedback on sales productivity. So again, that's someone who actually was solving a problem manually and using their startup to kind of import the information for the masses. For the graphics, it's not our expectation that founders know how to do everything, including digital design. And so do not be afraid, if you can afford it, to hire a professional person to help with graphic design for your pitch. And finally, of course, it's very important to frame the problem of what it is that you're trying to solve. One way to do that is to talk about the customers. So what groups of people are actually going to use your solution, and be as specific as possible. So I just have a couple examples here. US-based corporation with 500K employees in the manufacturing industry. Next slide, please. And a couple more. But again, just making sure that it's very specific. And if your plan is to start small and then expand your demographic, that's okay. As investors, we just want to know that you understand the market and see like where you would have the most impact given what you're trying to solve. Then there's this concept of explaining painkiller versus vitamin. That's just a fancy way of saying, is this a need or a want? So I want to know that if this solution isn't in the market ASAP, the world will end. You need to really describe how painful things are today and how your solution is going to save the day. For market potential, Gary already talks about how a lot of investors are looking to invest in a market potential of about $1 billion or more. So it's up to you to use your modeling skills to articulate a total addressable market and serviceable obtainable market. Of course, it's not going to be exact, but using intuitive clues to make the estimation. It might seem obvious to also talk about your solution, but you'd be surprised how many pictures I see that don't actually explain what it is that you're doing. So this is really important. And I love to say show versus tell. So the extent that you can show a screenshot versus text, etc., so I can actually see what it is that you're doing. And also the use of personas is very effective. So naming a customer and walking through the exact process. Here I have, imagine Sally is walking down the street, blah, 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 right? So I can actually picture the experience of your user, so I understand exactly what you're doing. And then finally, why now? It's very uncommon for a startup to be solving something that no one else has ever solved for. Typically, you're not the only one. So it's up to you to explain why you're the best person to be the founder and why the way you're solving the problem is the most unique. I once met a founder who I thought was smart, who had identified 6 other founders who had done what she was trying to do and all failed. She interviewed all of them and was able to articulate the lessons that they learned, and she put that into her deck. And so I felt like that was a really interesting way to show this is what's happened before, this is why I'm thinking about this differently, and this is why you can bet on me. Back to you, Gary. You're on mute.
Thanks, rookie mistake. And there was one thing I just wanted to kind of like add on what you said, Kange, which is when you're asking for the warm intro, just remember that this is someone else's network that they've worked a long time to develop. So I've had situations where you send the warm intro out and then the founder never follows up, or they follow up in a way that seems really unprofessional. And then all of a sudden that means my contacts have now been burned because it looks like I'm recommending bad people. So I think the only caveat I wanted to say there was when you are asking for a warm intro, just remember that someone is giving you like almost their baby, not quite maybe their cousin's baby. And you need to still take care of it, right? Because if not, then you can never ever come back and ask for anything from that person, as far as I'm concerned.
Good point.
So I'm going to
Gary,
jump.
sorry, one more thing to add on that, because you're right, is please be honest about the existing relationship that you have with the potential person for the warm intro. I've had founders say, introduce me to X investor. I send the email and the investor says, oh, I just talked to them last month, and they're trying to use me for like a second point of contact. And again, that affects my reputation. I'm more than happy to circle back, but if you just tell me that happened, then I can just say, I know you talked to Sean last month, but in the last month, this is what has changed. And this is the reason why I'm reintroducing you. So please just be honest about the relationship before you kind of set us up to send the warm intro email.
No, awesome. And so I think now we're going to look a little bit about the business model. So the last thing that Kange talked about was the why now question. And so you'll see this increasingly, like on the, for example, the Techstars and YC applications. For some people, that's the most important question, which is, an example would be Uber wouldn't be Uber before there were smartphones, because then you wouldn't have been able to book a phone from your house, right? And then you wouldn't be able to have location-based services. So that's an example of a technology that can only exist after another technology invent happened. Or like in the case of my company, I couldn't have existed until there was generative AI. So that's the wave I'm riding. So just remember, you have to kind of show that there's a wave that's happening that is growing the market so quickly that if you're the one that's able to ride it the most successfully, everyone becomes rich. And so I think tied to that then becomes a question of the business model, which is how do you make money? Again, we're going to repeat, is it recurring and scalable? Because what investors want to see is that you've mitigated the risks by showing that it's recurring. That's why there's a focus on monthly recurring revenue, annual recurring revenue, et cetera. And it's also scalable. It's growing 2 to 3x per year, right? Examples of business models, and you can just basically, Google it, use ChatGPT to kind of delve in more detail. But these are examples of companies that you probably know and might even love. One would be Netflix. That's a subscription model, right? You pay a certain amount of money per month. Now Netflix has also become an advertising model as we go below. So you can see that business models can evolve over time. They might be hybrids of different types of business models. Another example would be freemium. So Spotify has a subscription service. You can pay a certain amount per month, but they also have a freemium platform, which is that you have access to certain features without paying anything. A marketplace, you can think of those as like Amazon would be kind of like a definitive marketplace where it brings together two different parties that want to transact and takes a commission. Airbnb and Uber would be other examples of marketplaces. B2B SaaS, which is business to business software as a service. That's basically where someone is using cloud effectively to offer a service to another person and charge them a monthly subscription. So examples of that could be Zoom, Slack, Notion, etc. Advertising we talked about before, and I guess some of the best examples right now, at least, of kind of using advertising would be Google, Facebook, that make probably like 99% of their money just by using your personal data, offering the service for free, but then monetizing you as the product by selling your data to third parties who are really happy to then send you targeted ads. And then lastly, you have pay as you go or user-based pricing. Here you might think about a lot of the cloud providers where the more you use, the more you pay. So those are just some examples of business models that are out there. So you don't have to think about reinventing the wheel, but you do need to at least come up with one that investors feel shows that how you're going to make money. A lot of some investors, especially at the early stages, say you don't really have to go into too much detail about your business models. Others will disagree. But I think in general, it shows some focus on understanding the investor's point of view if you at least have some plan as to how you're going to make money, because how you make money is going to determine how much money you can make and therefore the likelihood that you're going to be able to exit at a price that they find interesting. So that's kind of what we'd say there. Traction, we talked about a little bit before, that really people want to see, are you still in the valley of death or are you kind of more towards the later stages, which will then mean something that looks like product market fit, competition. Here you can think about three different types of potential like competitors. You can have direct competitors. So I'll use my startup as an example. We said we're Perplexity meets LinkedIn for founders. Example of direct competitors would be companies that are also using AI to connect founders to investors. Indirect competitors might be accelerators that are not using AI but are trying to solve the same problem. And substitutes might be like Airtable, where there are a lot of people that are on LinkedIn saying, here's an Airtable with like 1,000 people who are investors. So it's not using the AI, but it is something that people can use instead of using our platform. So you kind of want to have a sense as to who your direct competitors are. Those are the ones that are going to be the most important. Who your indirect competitors are, because a lot of times they may be the incumbents, the non-startups that kind of have a lot of money and a lot of branding. So kind of have some sense to them. And then the substitutes, which might be, not that technological, but are still kind of just what people are using currently, maybe even be the default option, and explain why you're 10 times better. Because it's not going to be enough if you do something and you just kind of change the color or you're a little bit better. Investors want to understand, like, why are you so much better that when the competition comes for you, you're still going to win? Do you have some sort of a defensive moat? Would be the question that people would ask. Like, I want to know if I'm giving you my money, that competitor down the street is not going to beat you and then I just lost all my money. That's, I think, essentially how you have to think about the answer to that question. And similarly, when you think about team, a lot of times when people are kind of telling you about their teams, they'll say, oh, so Gary went to Yale and, Kange went to MIT and we are like best friends and we just really like working together. That's awesome. That doesn't help me to figure out like if you're mitigating the risk. So if, for example, going back to my co-founder AI, right now we're in customer acquisition phase, what I'm really trying to figure out is who's building the product and who's in charge of acquiring the customers. Do these people have the relevant experience to beat their competitors, to go more quickly than their competitors? And if we do not have those skill sets on the team, is there a plan to acquire those skill sets so that we can run faster than the competition? So the team is really about, why is this the team to win, not simply, I would love to know more about you, at least for me. And then lastly, vision. What does the world look like if you win? Again, because the time frame is going to be, 5 to 10 years of an investment. If you win and you become one of these companies that becomes, a unicorn or at least a very large company that's disrupted an existing market, the world should look a lot different. So the world does look different because of Uber. The world does look different because of Airbnb. The world does look different because of ChatGPT. Those are examples of companies that get people really excited. And I think the better you're able to articulate a vision of why the world would be fundamentally different because of something that you've created, the easier it will be maybe to convince investors that this is something they should get excited about. And remember, a lot of investments about FOMO, so you might be able to convince them that they need to get on the bandwagon now, because if they wait too long, they're going to miss out on a huge opportunity. And lastly, and this is one that Kange and I have kind of talked a lot about, because I'm not entirely sure how at least I feel about it, the ask and the use of proceeds. Sometimes it's good to put it in there, and people will say that the default is that you should put it in there. I sometimes think it's better not to put it in there, just because a lot of investors don't actually put the average check size or all of their theses on their website. And so the worst is like when you send in a deck to someone who has not put it on their website, and the first thing they say is, oh, this is out of scope for us. So I think that until there's full transparency in the investor market about exactly what their thesis is and what the stages are and all of that kind of stuff, you can maybe hedge it a little bit by kind of not being completely transparent until you have that initial conversation. And then at that point, you can ask them the question, so what's your average check size? Is there something about your thesis that I should understand? And then you can tailor it in the moment to like what they say. Um, and then I think next we're going to kind of look a little bit at the common pitfalls to avoid before opening it up to you guys for the last 10 minutes. So I'll turn back over to Kange.
You want to take the first half?
Sure. So these are some like really easy mistakes. And I'm at a pitching competition now, and I've just seen them again, even for people who are raising a lot of money. The first is And I think it was Kange who mentioned this before. You do a 3-minute pitch, maybe even a 10-minute pitch, and at the end, I'm like, what do you do? If we've just spent 5 to 10 minutes together and you can't articulate what you do, then probably there's no point to talking to you. It's probably a bad sign about how you're going to acquire customers, your likelihood of raising funding with other investors, et cetera, et cetera. And I think this is why the first thing that Sequoia puts in the elements of a business plan is, can you explain what you do in 10 seconds, sorry, in one sentence? I think this is why people usually do things like Uber for dogs or whatever the case may be, to help people understand really quickly what it is that they're doing. And then, as Kange said, it's also really important to kind of take us through the user journey. If the pain is really deeply felt and the solution is going to lead to a eureka moment, can you help me understand how we go from deeply felt pain to eureka, right? And that should be able to be done relatively quickly in 1, 2, 3. And I want to see the product, because a lot of times people will be like, we have the product and we're raising like $10 million. And you're like, then where is it? Why are you hiding it? So I think that's the first one. The second one is, you finish, and I don't know how you make money. We've spoken about the business model. Investors are investing in businesses, or not investing in, especially as you get later down the kind of, investor kind of cycle. So you really need to kind of make sure people understand at least your hypothesis about how you want to make money. You have a lot of traction. So I saw this today. A founder was telling me about a consumer business that she had, and I was like, yeah, I'm not really sure. And she's like, we're doing $1.5 million in revenue. I was like, why don't you start with that? Because again, she wasn't pitching an investor pitch. And I feel like if you have a lot of traction, or if there are a few things that make you really unique, I was a NASA scientist and I'm building the NASA whatever, kind of bring that earlier on, and don't just put it parenthetically at the end as if it's another talking point. Remember that this is a pitch, it's a sales pitch. Identify the 3 things that you think really make you stand out, and make sure that they're kind of almost like the pillars or edifice of your pitch, and that those are the 3 things that come through clearly and consistently. The next is that the founder spent all time talking. This happened to me the other day. We had like about 15 minutes. The guy felt like about 12 minutes. And at the end, I didn't even really want to ask any questions, right? Because I feel like if we're having a conversation, then allow me as well to talk. I think that the best thing is that you should have like probably a really quick introduction, like a 2 to 3 minute pitch. And then the rest of it should be Q&A, because I really want to understand your business. I don't want to just hear you talking at me for 10 to 15 minutes. You should be ready for investor Q&A. So sometimes you see the opposite, where the founder has an amazing 2 to 3 minute pitch, and then you ask the first question, like, how do you acquire customers? And I'm like, I never thought about that. So it's not only the kind of pitch that you have to kind of practice, you should also practice the investor Q&A. And as you're listening to investors and you're hearing consistently some feedback, don't ignore the feedback. Start thinking about, why do I keep hearing the same questions? And then start to think about, what are the answers to those questions that I keep hearing? Because then you might even prepare a slide that answers those questions in your annex to your pitch deck. And investors will be impressed, because they'll see that you've really thought this through and you're not just kind of winging it. And then I think the last one before I turn over to Kange is not doing your research about the investor beforehand. As we've said, investors are there to kind of look for a very particular type of company that matches a thesis that they think is going to make their LPs really, really rich. You should kind of have a sense as to like what their thought process is about that, so that you can tailor your pitch to make sure that you look like what it is that they're looking for. With that, I'll turn it now over to Kange.
Thank you. Too much jargon is a big one. People use buzzy words like AI, formerly blockchain, whatever. Like, just use normal English to explain your startup. Don't try to, make things. I think if you can just explain your startup using normal words and not using buzzy MBA type words, you seem more credible. Some people say it's too complicated. I can't tell you this in a 15-minute call. I need to have a 30-minute call. I think, again, back to having the 1 sentence description. If you can't tell me what you're doing right away, then I worry that it's not a good product. And if you think about any marketing campaign you've ever seen, there's not often you see a commercial that's longer than 6 minutes, right? So that means that you can't put this into the market. Exaggeration is a big one. Investors, like we said before, talk to a lot of startups. And so anytime you say something exaggerated, like we don't have any competitors or things like that, founder knows right away that that's not the case, which is also the next pitfall I have here. Winging it, just always make sure you're prepared in a pitch. It's very obvious when someone doesn't know what the next slide is, for example. Seems pretty straightforward, but just be kind and gracious. As I mentioned, rapport with investors is important. So if you're running late, apologize. If just always just be gracious. And then aesthetically on Zoom, try your best to be in good lighting, not a place that's not noisy, etc. And then one of my biggest pet peeves is when I meet a founder, I ask them to send me material and they say first you need to send an NDA. Again, if you can't tell somebody about your business without worrying they're going to take it, then it's not defensible and it won't be successful. So that was a lot of information. We're going to now transition to the Q&A. But before we do, I want to thank you all for your attention and remind you that after this, we are going to send an email with the slides, the recording, a survey, and also a link to apply for funding from Level Up. Over to you,
And
Sasha. So the question.
sorry, Kange, can I just say one thing really quickly?
Mhm.
Because like I said, I've been at this conference all day, and I think the one thing that came through to me is just remember that this is a relationship game. At the end of the day, VC is really about very small circles of people that have agreed to spend the next 7 to 10 years of their lives together. And so it's about building long-term relationships, not thinking transactionally, and making sure that people actually want to spend time with you and have good memories when they think about you. Because if not, if they have a bad memory, even if you have like lots of traction, it may not work to your benefit. So again, just to reinforce what Kange said, be kind, be nice, make sure people have a good memory of you, and kind of think about this from a long-term perspective, not a short-term. And with that, I'll turn it over now to Shashi.
Great, great. Thanks, guys. We have a lot of really good questions here. I neglected before to mention we have actually 2 teammates on the call, Ike Iwator and Shanna Miller. Without Shanna, we could not have gotten this scheduled and up and running as smoothly as it did. So thank you, Shanna. So I am going to unmute the people that asked the question. I'll read the question. If you have anything to add to it, feel free to jump in. The first one is from Gabriel Garcia. What if you are pre-seed without any revenue generation? And I assume that you mean how should a founder kind of communicate their traction if they're just starting out and don't yet have any revenue? And Gabriel, you've been unmuted if you'd like to add.
Yeah, so it's in relation to the slide that I believe Gary was talking about, showing your revenue. You basically just said what I wanted to ask.
Okay, no problem.
Awesome. Kange, you want to take it or want me to go?
Yeah, I can start. So I think you're saying if you're pre-seed and don't have revenue, should you still approach investors? The answer is it could be, depending on the company. There's also ways to show traction. So for example, if you have a pilot, in the enterprise case, sometimes you have a non-paid pilot with a credible brand, and the brand would be happy to talk to investors to say that they are in fact doing a pilot. I've also seen focus groups, waiting lists, etc. So it doesn't necessarily disqualify you, but you do have to come up with another creative way to demonstrate that the market is asking for this. But then also that could mean that you maybe just switch investors. So instead of going to a VC, an angel investor might be more likely to be okay with investing, even if they don't see revenue at that stage. Gary, anything else?
Yeah, no, I think that's it. I mean, there might be an investor for you. It might just not be a VC, or it might be only a very particular subset of VCs. Just make sure that you go after those folks. And then the other thing is just remember that a lot of the early stage is meant to be about bootstrapping, unfortunately, getting your fans and family to invest in you in the historical context. And then also non-dilutive funding. So increasingly you're seeing a lot of those. And just remember that it's not all about VC. VC is really meant for like a very tiny percentage of the companies out there. But there are other funding sources, and don't be blinded thinking that only VC is the answer.
Okay, great.
Okay, thank you.
Thanks, Gabriel. Next question is from Jay Veal. Let me unmute you here. So we had a couple of questions here about the funnel slide from A16Z. And Jay's question was, I assume you'd need to be past pre-seed and the MVP stage where revenue is moving forward. Is that correct? Or would you need to submit projected financials also if you're in MVP stage? So essentially, do you have to be beyond a certain point in order to send financials? Would they be expected before that?
I think it's kind of similar to the last question, which is like, Sequoia is probably investing at like Series A, and then probably maybe even late Series A, right? They sometimes say that they'll invest at like seed stage, but that's if you're a repeat founder that comes in with a lot of warm intros in a space that they're really excited about. But that's not for the average founder. So I think that founders should just kind of think that for the first 2 to 4 years, they're probably not ready for Sequoia. Maybe if they're doing something extraordinary and the company's growing extraordinarily well, then there may be that exception. But during those first couple of years when you're building the product and things like that, you should probably stick with the investors and the funding sources that are specifically created for you. It's likely the case that Sequoia is not.
Great.
All right, and the reason why I asked that is because we're in an interesting, unique space, I guess, where I've already launched a company. We've been in existence for about 7 years. So in total of that, we've had about 1.8 million in revenue, in earned revenue. But now we're transitioning to an ed tech company, with the platform that we're building and trying to get an MVP built for. Right now, we have some pre things that we need to accomplish before pushing out to the MVP. So we haven't had any traction in the ed tech stage, but we've had traction in the regular business side of what we've been doing for the past 7 years. And that's why I kind of wanted to look at that delineation. We've been in all the major media outlets as you can think of, but we just need to now move to doing different things in ed tech to scale. That's why I wanted to kind of get that difference there.
I think
Yeah,
if
the only
the previous, oh, sorry, Gary.
no, go ahead.
If the previous startup with the 1.8 million can help to fund this one in a practical business way, that makes sense. But if it's a complete pivot and the other way you generate money is not going to apply at all to a new one, then you should think of it as a different company in terms
Yeah,
of
and
investments.
the only two things I was going to add would be one, make sure your messaging is clear because people are going to look at like how did you spend the money that you had before. Two, they would want to understand really clearly, and I'm going through this as well, like why the pivot. And three, they would want to understand whether your existing investors are still with you or if they've already abandoned you, right? Because if your existing investors abandon you and you just kind of ran out of capital and now you're trying to pivot, that may not be as compelling a story. So you have to really think about how you're going to explain this, and kind of like what are the assets you're going to use to kind of make it look like a success as opposed to a failure.
Gotcha. Thanks.
Thanks for your question, Jay. The next question is from Alakia. I apologize if I'm pronouncing your name incorrectly. How might the percentages from the A16Z funnel look similar or different to more industry-specific VC firms or less popular firms? I'll actually take that one. So, I wouldn't say, Level Up Ventures is less popular, but maybe not as well known. We're about 4 years old, and we've actually looked at this a lot. Our numbers are very much in line with A16Z's funnel. The fact is that 1% on the high end really make it through to investment committee. For us, it's closer to, I think it was 0.8%. And so, all VCs are looking for the best of the best. And so it's really, ultimately just a numbers game. And I expect that even for sector specific VCs, the same is true.
Okay.
Yeah, the only thing I'd add is just think of like VC as like they're looking for the next Simone Biles in whatever category it is that you're in. They're not looking for someone who likes to do a cartwheel. So they have to really see outsized potential in order to be able to contemplate outsized returns. So you have to think about it that way. And if you don't think you're quite there yet, then look at other sources of funding, but don't think that VC is going to be the answer for them. They're looking for a very particular thing.
No, I mean the question and Alakaya, but the question really is around. I think thank you, Shashi, by the way, for that. Obviously A16Z might be, one of the most famous VCs, Sequoia, etc. But they're also generalist, and particularly right now as we're considering talking to generalists versus talking to prop tech investors, which is a relevant category for us, right? We would expect there might be a difference when people are more aligned, like you guys kind of reference. So that's where I was sort of looking for data, but that's the only thing that I'd add. Otherwise, the feedback's been helpful.
Yeah, I think it comes down to sourcing. You're still finding all of the companies that kind of fall within your sector. So it's still kind of, it's still a percentage of that. So if you're not doing it, if you're not looking across sectors, even if you're looking at something specifically, if you're doing it, if you're VCing properly, you still have that volume of deal flow.
Yeah, I mean, the only thing I would add is that, like, to Shashi's point, it's like VC is all about trying to find, like, if you were talking about singing, the next Whitney Houston, I mean, maybe that's biased to me, maybe the next Beyonce. So part of the job, probably the big part of the job is scouting, right? That is what you're really trying to focus on. Like, how do I find these really amazing companies? So to give you numbers that are not Sequoia specific, at Techstars in my program, we got 2,400 applications for 12 slots, right? So it's still kind of always the same, and probably every fund is going to try to make sure that they have like a very healthy pipeline of choices, that they're not limited to just what comes in front of them. So it's all going to be kind of benchmarked around the same, even if they're generalist specific, early stage, later stage. The whole point is make sure you see a lot of stuff and that you can reject 99% of them.
Great. We have several more questions, so I'm going to try and run through these quickly. The next one is Bijou Menon. Essentially, he wants to know why do we ask, why are you the best founder to start this startup? He doesn't feel like it's a helpful question. Is that accurate, Bijou?
Yeah, because I historically I've seen founders who's got no experience in a particular space as done wonders. Okay, you can always come up with an answer, but is that the purpose of the exercise? When you have a time with investor or founder, it's about finding the business and the potential, right? And these kind of cliche questions, I keep seeing and hearing it, and I just doesn't make any sense. Part of my ignorance, right? I'm
No,
having a different mindset, but
Yeah.
I'm trying to
it's
be
a good question. Yeah, it's a good question, and it can seem a little bit condescending when it's phrased the way you said it, which it is many times. But earlier, what I said earlier is it is really true that most of the time as an investor, when you're seeing a startup, you've seen 10 other ones very similar to this before that. And so the question usually is not, it's not always, but usually it's not, I don't believe in the problem you're solving. It's, I want to know that you can solve it in a way that's different or execute in a way that's different from the other 10 I saw. And so that's when you talk about whatever it is your superpower is. You have experience in the domain, you have specific passion, you have a great team, you already have customers, whatever it is. It's not an attack on like you as a person, but just like your ability to lead and get to the returns that they want to see. Because again, this is not necessarily a unique startup in the eyes of the investor.
Gotcha.
And I'd add to that just quickly before we move to the next question. Storytelling is a huge part of pitching your company, right? And every founder is uniquely positioned to run their company for a reason. And this is really a question we ask to try and get that out of you, right? Like, why are you uniquely positioned to run this company? What about you, your background? Everybody's so different. Everybody has such different experiences. So this is really your opportunity to explain why you are uniquely positioned to run this company and why you will do the best job. So I would maybe look at it that way.
Shashi, can I just add one thing, which is if you think about it, the idea is not the important thing, it's the execution. And so this is really a question about how well are you going to be able to execute and what evidence do we have of your ability to execute at a world-class level. So that's what the question is really trying to get at.
Thank you.
Hope that was helpful, Bijou.
Yeah, I appreciate it. Thank you so much.
Sure. The next question is from Jamie Taylor. Kange mentioned reaching out to founders who may have failed in my industry, but is it common to get info from successful founders in the industry? If so, what are some questions that you recommend we ask that will help us when talking to investors?
Interesting. So you're basically saying, how do you learn from your competitors? I don't know if you necessarily would talk to your competitors directly, because they're competitors, but you can still do research to see what they're doing and how you can best position yourself compared to them. I don't know if Jamie, if I answered your question.
Jamie?
Yes, you answered my question. I think I was just wanting to see if that was something that happens ever. People go to the actual competitor to try to investigate, maybe not as a competitor, but as a, maybe undercover to get some information. If there were some questions that you thought might be helpful to get answers to help with talking to investors.
Yeah, for sure. I mean, at large corporations, you typically have like full teams that do like competitive market analysis, where they routinely follow the top 5 companies that they feel to be in the same space, looking at their earnings, the wins they've had, who they're hiring, all that stuff. And so that's just a good way to learn. It's also a good way to poach talent potentially. So things like that.
Great. Thanks, Jamie, for your question. Another question here from Jay Veal. Why would doing an NDA be a pitfall if you send your deck and tell someone what you're doing and they don't invest? They could take what you're doing and share it with someone else. So I'll take that. I think here's the thing. This is all about execution. There are a lot ideas there are tons of ideas out there. And if everybody was able to execute and bring those to life, there'd be a lot more successful startups out there. This is truly an execution play. And if you've got IP or you've got something really sensitive that you're concerned about kind of telling investors about, you don't have to give them those details until you kind of get further along in the process. You can really be thoughtful about kind of what you share and what you don't. The more you can share, the better, so we really can understand the full picture. But keep in mind, part of the reason why we at Level Up would never sign an NDA, you saw the funnel, right? We look at thousands of companies every year. There's no way we could sign an NDA for all of them. And frankly, we're not looking to take, that's not our job. We're not looking to build companies, right? We're looking to invest in those amazing founders who are going to build amazing companies. The one caveat I would say where I have seen things happen that maybe you might be referring to. Every now and again, I've heard from founders that maybe a investor has a similar company in their portfolio, right? And they kind of shared what you were working on with their company. I think it really comes down to for that really doing your research on investors, right? As much as we're doing our research on you and your market, you should be doing the same thing with investors. We all kind of we all have reputations, right? Speak to people that we've invested it to talk to our portfolio companies, but do what you can to try and identify those folks that are going to be authentic and upfront with you, and hopefully not do that.
And just to add on to that, I agree with everything Shashi said, but it's also a market indicator, because at some point you're going to put your product in the market. So if you're saying that when people know about the product, they can copy it, then what are we talking about, right? That means it's not going to be a successful business. Now, there are cases where you're early stage and you're like a science company or something where you're waiting for an IP to come through. And so that's why you don't want to share it, because you don't have anything defensible at this moment. But if you're just worried in general that the idea is easy to replicate, then it'll be hard to be competitive.
Okay.
The only caveat I would say to that is maybe at the due diligence phase, if you do have like very specific IP and they ask you specifically, can we see it? Then that may be an area where you can ask if you can kind of like have some sort of confidentiality, right? So that would be the only caveat that I would say. Once you get to the due diligence phase and people are basically saying, can we see the code or whatever, you should have the right to say either no or yes, but I need to get some protection.
Yeah, and to be clear, when I was talking about the pitfalls before, it was just, I've had people say, I don't want to show you a deck at all, not the due diligence, to Gary's point. So of course, if you have code, I don't think it's appropriate for people to look at that, but you should be able to talk about the idea in a general sense without being worried that if you talk about it, it can't be successful.
Yeah, in those cases, we would just pass.
Right.
Okay, thanks for your question, Jay.
Thanks. Thanks. Made sense. Everybody's answers kind of hit on everything I was kind of looking for with that.
Okay.
So appreciate everybody's response.
Good. That's the goal. Good. Next question is from David. How do we explain to investors why our revenue dropped if funding was the issue?
That's a good question. It happens a lot.
So David, do you want to maybe elaborate on that? Is it that you needed additional capital in order to keep sales going, or in order to grow the company, scale the company? Is that what you're talking about? You're on mute. I'm not sure if you're speaking, David.
Yeah, I was talking to myself. Hi guys. So I think it's just more of like with the current situation that we're going through. So we had an issue with a person in charge of like delivery, because we run a marketplace for food and beverage retailers. So we had an issue with a delivery person, and I'm in charge of sales. So now because we don't if we don't sell, we won't be able to make money. So I kind of like do the sales and run the delivery. And last year we did about 770,000, and this year we're about like to do $1 million. But just because I run both the sales and the logistics, basically, it really affected our sales. So but let's say we had like working capital, or we're able to raise money, it would have been easier to just get a driver, or again, it was just like the funding was the main issue for us. And all these things that we're building is just for us to like pivot. We're trying to like pivot and build the entire marketplace again. So before we kind of like start pursuing VCs, but if we want to show them our revenue, now the revenue would drop. And so I'm just trying to look for a way to see how we can, let them understand, or this is what happened, and be positive about the reason why we had a reduction in our revenue.
So I'll just answer that quickly. So here's the thing, VC, just like every other market, goes in fits and spurts, right? It's very fluid, and there are times that it's very difficult to raise, and there are times where it's easier to raise. VCs are very aware of the trends. VCs are very aware of times when it's more difficult to raise. And I think they absolutely understand when, if you're having a hard time raising and that's why your revenue is being impacted, or any of your other traction, KPIs are being impacted. And so I think the best thing you can do is just be honest, and explain, your situation, where things are, and why you need to raise, because, your revenue would actually be, straight up and to the right if you could just raise, that other $1 million, and be able to articulate that really clearly. And I think that will really help the story, and help you, have a good conversation with the investor.
One thing to add on to that is, when I was hearing your story, I think I heard you say that there were some levers. So for example, there's times when you're growing quickly, like an enterprise case, for example, like maybe you sold something, you need to have a team of consultants to implement it, but because you've sold so many, you don't have a team to do that. And so you can't take the revenue. And so sometimes when you present that to investors, it's like, you could explain that you need the money because of your success and how you scaled. And that sometimes that's an interesting way to frame it, to know that there's a direct line to how you would continue to grow.
Yeah, and the only thing I'll just add is, even if it's being impacted because you didn't have the money to do something, I think the unit economics wouldn't fundamentally change. So just make sure that those numbers kind of still make sense from a kind of investor point of view.
Mm-hmm.
Okay, hopefully that answers your question, David.
Thank you so much. Yes.
Thank you. Okay, and then the last question, Raphael Balbi. Thanks for this. You're welcome. I'm a pre-seed founder with thousands in revenue. App launch in April, consumer AI space. I've heard I don't have enough traction. Any more traction in my mind would make me a seed stage company. Where is my story falling short?
Can we ask how much revenue you have and is it recurring on a monthly basis?
Raphael, you're able to, you're on mute, but you're able to chat if you'd like to unmute yourself. Okay, Raphael may have money.
Yeah, I mean, I think the general answer to the question is just make sure you're targeting the right investors. If you're talking to investors that are kind of like seed stage, but they have a threshold of 25,000 to 50,000 monthly recurring revenue, and you're at 10 or 15, that's why they would think you're too early. Make sure you're targeting the right investors that kind of think that what you've achieved is what they're looking for. And if you haven't achieved their thresholds, then they're not going to invest in you, even if it is kind of still successful by other standards. So I hope that kind of explains it. It's just think about it it's not that the investor is good or bad, or that your company is good or bad. It's that they need to see certain things in order to kind of tick certain boxes. And if you don't tick those boxes, it may be the case that they say you're too early for them. But once you tick those boxes, you might be at the right stage for them. But it just probably means that you need to look at other investors or understand more clearly what it is that they think that you're lacking.
At the same time, there is bias in the process. And so sometimes people will use that as an excuse when if you really are where you think you should be in terms of, the slide Gary showed about the ranges, sometimes it's the wrong investor, not because it's not what they invest in, they're just the wrong investor for you in any case, because they'll just keep moving the goalpost. So again, I don't know your numbers, but don't get discouraged if you really do think you are where you should be.
Okay.
Yeah, congratulations on traction.
Right.
All right. Well, we are over time, so I apologize to everyone for going over, but hopefully that Q&A session was helpful for you. Just want to draw your attention to two things that we put in the chat. One is a feedback form for this event. We want to know if we should do more of these, if this was helpful, if there's something that we could do better. So we'd really appreciate if you would fill that out. And then the second link is a link to our criteria, followed by a link to our submission form, if you're interested in speaking to us for an investment. So with that, again, want to thank everybody for their time, and we wish you all the best of luck. Thanks so much.
Thank you.